So, good morning, good afternoon, good evening, my friends. Somebody asked me to discuss about or try to illustrate about how I identify liquidity in the market. So, I'm just going to do a very quick video. I'll just try to bring up a pair. Let me see what pair, what pair. Maybe USD JPY, USD JPY. USD JPY. There you go. So I'll try to bring up the pair USD JPY. So this is USD JPY. Normally when I'm trading, I always have my 5 rules that I follow. So I'll just try to put the rules here so that everyone can see. When I come, let me just try to put it bigger. That's too big. Oh, there you go. I think that can be seen. So when I come onto the market and I want to identify the liquidity on the market, basically this is my 5 things that I always look at. But for today, we're just going to maybe discuss up to point number 3. My first rule is I try to identify the trend structure. The second rule is I try to look at where is the money, and which is the most important topic for today, the liquidity. And for the liquidity, what I always look at, I look at the double tops and the double bottoms, or in other words, you can call it equal tops or equal bottoms. And then I'll also try to look at the market gap and the market imbalance. So since today we're looking at this pair, I'll just quickly try to have a look at it. So first we look at the market structure, and when I'm looking at the market structure, what I always look at is I try to do what we call a top-down analysis. By a top-down analysis, it means I start to look at the market from the monthly perspective. So for this pair USD JPY, if you're looking at it from a monthly perspective, we see that this pair has been ranging all the way from 2017. So if you can say it has been ranging, by ranging means its price oscillates between a different between a specific time frame, a specific point to another point. So what this basically means is price has been moving from here up to here and goes back. So if your price is ranging, it basically means that you can get into a sell or a buy when price is ranging, even on a higher time frame. Let me illustrate. On a higher time frame, this point is around 118.79, and price has been ranging up to 100.97. So if someone was to trade this particular pair, even on a monthly time frame, if you try to see how many pips are this, look at that. Look at that. It shows how many pips are that. So it just basically says that you can trade this on a monthly or on when price is ranging. If we drop down to a weekly, now it's the price starts becoming clear, so that we see the regions where price has been ranging clearly. And if you drop down to the daily, still the same thing. It just shows you how price has been ranging, and 4 hour time frame, it should still be the same thing. So if I want to identify the liquidity in the market, so number one, as you have seen, if you go back to the monthly time frame, number one, as you have already seen, that we look at the market structure. I've already looked at this market structure. There are two things that we can say. The one, the market has been ranging for a very long period of time, and number two, we can see that this market generally it has been on an upward trend, and it started moving from an upward trend in 2012. Went all the way, the price reached the trend line and reversed, going upward. So from here we can see that either price can go either way. It can either decide to go upwards, we get that, it can either decide to go upwards, there you go, or price can either decide to come back all the way up to the trend line, because that's how it has been going. If you look at it keenly, that price has moved from here, um, price has moved all the way from here to there, reversed, came here, came back all the way, and now price is here. So, and this is the way the market moves. The way the market moves, it moves in a zigzag motion. So it goes up, down, up, down, up, down. So having said that, we have already identified the market trend, which is in two way. You have seen the ranging part of it, and you've seen the market is in an upward trend. So that basically shows that you've already looked at the market trend. Then the second thing that we're going to look at, we're going to look at where is the money. And when you're looking at where is the money, there are two things we consider. We look at where are the double tops and the double bottoms. So if I was looking at this market, so for example, let me drop down to like a 4 hour time frame. If I was looking at this market in a 4 hour time frame, I'll try to look at where is the money at. So where I'm looking at where the money is at, I'll try to check at these double tops and double bottoms. So for example, if I look at here, we have these equal tops or double tops there. And if I was looking at on the downer side, this area will mark a very good area, because at times when you're looking at the market, you don't exactly just look at the exact price, but you can look at the exact region or level. And if we are to expand this on the left, we see that this region has been respected before. So that basically means is most likely that this is the liquidity area around on this market. So but what I mean by liquidity area, what that basically shows is liquidity area is when people, we see when price moved from this here to there, it means people, small traders like you and I, left their stop losses around here. This is where they left their stop losses. And in other scenarios, you'll find that there are other traders who will put their sell orders here, because this place has somehow been respected twice. Around this region has somehow been respected twice before. So most traders will know that next time when the price comes here and it goes into a sell, even if I'm not on the market, I would like to get into the trade. So they will leave their stop orders here, and some of them will leave their buy orders. So what that basically just that means that this is where the liquidity place is, and this is the liquidity area. So after identifying the liquidity area, and as I've said, liquidity area, you can either identify it by that equal tops or equal bottoms, or alternatively, you can use the trend line. By trend line, it just says that uh, price has been reaching this specific level and it reverses. That specific level, it reverses, and it has reached here another time and it reverses. So what it just says that there are traders who leave their buy orders here, because they know every time price touches the trend line, we're in for a buy. Every time price touches the trend line, we're in for a buy. So this is also another liquidity area that you can identify. Another liquidity area that I identify using smart money trading style is we identify the market gaps. And the market gaps is we always identify them normally when the market makes these huge candles like these ones, these huge candles. They usually leave some market gaps. So market gap, when the market is moving upwards or downwards, what basically means is this price here should be corrected by the next candle. And like you see here, price has been corrected by the next candle. But if I show you clearly this place here, you find that there is a gap. So I'll try to do that and just do that, and try to reduce the size of this to one. So you find there's already a gap that when price was going up, the other candle that came in did not clear this gap. But what the market makers will do is they'll always come to look for these places. Like when they did that, they moved price to here and came back all the way and cleared this market gap. So it's just the same way as they have done here. They pushed price down, and we're using the 4 hour time frame. So if I was looking at the market gap, I look at this as a market gap going forward. So what this basically tells me is after some time, this move will be corrected, and already you've seen they've started correcting it. So the way the market moves, it does not move once unless there's news. That's why you see these big candles. But basically, they will try to correct this market like that, this market gap. It might even take 100 days or 20 days to clear, or it might even take as long as it takes, because in trading, we always believe that price will always be respected. So that's how they can decide to clear this market gap. Alternatively, they can just decide to clear it with one candle, like the way they did here, just push price and clear this market gap. So these are the areas that for me I look at as liquidity areas. One, we have this, equal bottoms or equal tops. These are liquidity areas. Or you look at the trend line where the price hits the trend line and reverts. That's a liquidity area. And also these market gaps are also liquidity areas. And then one final one that we always call a liquidity area is where we have the order block. So an order block is like this region here. Another block is that you look when you're looking at what you call an order block is that last candle that happened before price moved either way. So this was the last candle that happened before price started going up. So what that basically shows you is that if that is the order block, the market will always come back and correct this place. It will always come back and fill this order block. And if we can demonstrate this, it came back later on and corrected this order block as you have seen here. The price has to come back to that order block. And the same applies on so you have a demand order block, which is this one when you're going into a buy, and you have a sell order block. So, for example, if you're looking at a sell order block, we can say, like, let's say this one, you can call it, you can say this was an order block. Let me just try to put a triangle there. This was an order block here before price came down. Or alternatively, you can use that, the last up candle before price came down. So you can use that as an order block. So before price decided to go into a sell, there's this order block that was left here. But what happened is the market went and came back later on and filled this order block. So for me, if I'm looking at the liquidity areas on the charts, this is what guides me and this is what helps me to look at the liquidity areas on the market. So one, we have the order blocks. Two, we have equal tops and equal bottoms. And then three, we have this market gap or market imbalances for those who use smart money trading strategy. And lastly, we have the trend line. So this is where these are the regions where you look at for liquidity when you come onto the charts. I want to listen to your views, or want to know what you guys think about this video. Leave a comment and either press the like or dislike button so that I can know what are the views of my fans out there and my followers out there. Thank you so much and God bless you.